Okay, and this is the first week finally I was able to get YouTube to work on Zoom. So we are going to be moving forward streaming to YouTube. So if you can't make the Zoom, you can be on YouTube. The Zoom is probably going to be the one that first week finally I was able to get YouTube to work. Hold on, give me 1 second. I gotta hit this. Perfect. All right. So if you can't make it to the Zoom, you guys can be on YouTube. Usually the Zoom is going to be the one that gets the attention in terms of questions and stuff like that. So all right, we'll be starting in a minute. Hey, Lorraine, how are you?
Great morning, bonjour. I'm well. How are you?
I'm doing well. I'm doing well. You were on vacation?
No, I've been back. We got a closing this week.
Yes, we do. Yes, we do. Okay, all right, let's get started because the number one topic that we've been beating up, inflation, right? Inflation, inflation, inflation. That is unfortunately the name of the game right now. The consumer price index, which measures inflation on the consumer level, showed a 0.1% increase month over month in August. Remember that last week when we were having our Monday Mortgage Minute that I said that the expectations were negative 0.1% month over month. So that difference for the people that had that expectation, which typically the experts and stuff like that, they kind of figure these things out, try to figure these things out ahead of time. That's a 0.2% bump up to what they were expecting, right? So the markets did not react well at all. It's actually been since last week, rates have just been continuing to increase. Even right now at pre-market, mortgage-backed securities are about negative 30 basis points. So, I mean, rates at 6.5, almost 7 are going to be the norm for at least the short term. It may not be like this for more than, I would say, a month, but definitely going to be like this for the short term in terms of, people being locked in at that 6.5, maybe even 7 if we continue to go down this path. Unfortunately, we did see that annually inflation actually went down. It declined from 8.5% to 8.3%, right? And for those of you who weren't here last week, how does inflation move up month over month, 0.1%, but inflation year over year declines? Because we're taking into consideration last year's inflation readings as well, right? So if last year's inflation was 0.3% and we go up 0.1%, let's say, inflation's at 8.5% year over year, right? So if we go up 0.1%, that would put inflation at 8.6%. The 8.5 plus that month over month, 0.1%. But then you have to minus out what last year's was. Last year's was 0.3%. So that's how we went negative. We went from 8.6, but year over year is 8.3% inflation because we're discounting last year's inflation report. So we're still showing that we're declining. This is the good news for us in terms of what we're looking at 2-3 months down the road. Because remember, I've said that the summer months in terms of July, August, September were going to be the hardest until we got the reading for July. And I was like, okay, maybe not, because July was negative, but now we get the reading for August and it's positive. So the reason why I said July, August, and September were going to be the hardest is because those readings for last year were like at 0.2%, 0.3%, 0.4%. So the year over year is still going to be pretty great, as opposed to October. Last year, inflation was at 0.9% for October. So if we do that same math, right, let's say we have a 0.1% increase, let's say, and let's say we go from 8.3% to 8.4%, but now we have to minus out 0.9%. We're going to be at 7.5% inflation, given that example. So that's why the year over year is very important, or what we were at last year is very important, because we're going to have to see, or we're going to have to utilize those numbers and minus them out. So I'm waiting for, because those October readings are going to come out in November. Hopefully by October, we're okay. But for sure by November, we should start to see mortgage-backed securities really steady out on the downturn, meaning that, or on the upturn in this case, because mortgage-backed securities, when they go up, rates are lower, we should start to see them starting in November really stabilize and try to go towards the uptrend, because we're going to see lower year over year readings, much lower year over year readings. Okay. The good thing is that the Fed will have their meeting this week between tomorrow and Wednesday. And they are expected to raise their Fed funds rate 75 basis points. And remember, that is not good for the economy, but in the short term, it's good for mortgage-backed securities and for interest rates. And right now, we need that help, even if it's for a day or two. So what's going to happen is once they raise their Fed funds rate, remember, they're doing that to fight inflation. Mortgage-backed securities, the number one enemy to that is inflation. So as they combat that, the market's going to react positively towards it, even though we're not going to get our next inflation reading until next month. But in the short term, though, that next day or two, we're going to see some really good buying in mortgage-backed securities, which is going to help us with pricing in terms of interest rates and stuff like that. Initial jobless claims are continuing to tick lower and lower. Initial jobless claims are people basically who filed for unemployment for the first time. And the reason why we look at this number is because this is typically the last domino to fall before we actually really see a recession. So last week was at 213,000, down from 218,000. However, continuing claims, they're staying steady. They're at the same number as last week. They went up like 2,000 people, not too much, but it's about 1.4 million people still on receiving unemployment claims. That number is going to continue to increase little by little, not week by week, but for sure month by month, as we continue to kind of go in this direction with the economy. Legacy Home Loans, they are the largest Black-led mortgage banking firm, and they launched another special purpose credit program called Closing the Gap. And this is allowing Black borrowers to come in with as little as 1% down with free appraisal, free home warranty, and free home buying counseling. Now, this is not in South Florida yet. It's not in Florida at all, but they are starting this program in cities like Atlanta, Baltimore, Chicago, Detroit, Memphis, and Philadelphia. Borrowers will have to reside in a census tract that has 51% or more Black population. Minimum FICO of 620 is required. And this is a Fannie Mae / Freddie Mac product, meaning conventional NDUs still have to run and give an approved eligible. Now, the reason why I bring this up, even though it's not in our local cities, is one, so that you guys are informed, because I know that you've heard about or you've seen it on social media already. But two, we spoke about special purpose credit programs being accepted by Fannie Mae and Freddie Mac back in August. And I said at that time, I think it's going to take about a year or two before we actually start seeing these things. And it only took a month, which is really, really good news for us, especially when we have first-time home buyers, because a lot of them are going to need to be able to use these home buying, these down payment assistance programs. And the fact that Fannie Mae and Freddie Mac are now accepting them is really opening the gates for lenders to come out with their own stuff. With these grants like Bank of America did, like Legacy Home Loans is doing, they're really opening the gate to be able to push home ownership, not only in minority communities, specifically Black and Hispanic, but just in general, right? We have to close that gap in terms of home ownership. 74% of white people own homes, 49% Hispanic do, and 44% Black families do. So definitely closing that gap is going to help, but ultimately seeing that Fannie Mae and Freddie Mac accepting these is now getting lenders to be receptive of it. That's the reason why it didn't happen before, by the way, because special purpose credit programs have been out for quite some time. And I did this in my Bank of America YouTube video as well, where I explained that special purpose credit programs, what these are. And I didn't really go in depth. I made another video that will be going on YouTube this week that is specifically explaining special purpose credit programs, why they're out, because you hear people that, oh, why aren't, whites able to get into this? This is steering and stuff like that. This is legal. What they're doing is legal, and Fannie Mae and Freddie Mac are actually buying these loans, and that's the reason why they're doing them now. What else? With rates shooting up, your buyers, they're going to continue to be unreceptive, okay? They're not going to, if they're pre-approved, they may want to slow down on looking. If they're looking about getting pre-approved, they may be a little bit hesitant. They may think about re-signing that lease one more time, especially if their landlord isn't going to be increasing their rents. And even if the rent is high, as long as that number stays the same for them, they may end up re-signing that lease. It's very important for us to be able to kind of navigate around to help people get into homes, because honestly, when I don't feel guilty telling somebody that you cannot rent, even if interest rates are at 7%, because you're doing them a favor. It's not like you're not doing them a favor, right? So when you're talking to these clients, you need to come off like, hey, this is for your own good. Like, I'm not trying to sell you crack on the streets. I'm really trying to sell you home ownership and generational wealth. Like, this is legit for you. And it doesn't matter whether you're renting or you're living at home. Buying a home is always going to be the better option, even at a higher interest rate. And what I'm pushing is the 2-1 buy down on clients that are on the fence, because let's say interest rates are at 6.5 for them. All right. They can start off their first year at 4.5% interest rate, and that's what they're going to be paying on their mortgage for, like a 4.5 interest rate mortgage. And then their second year is going to be 5.5% interest rate. And then that third year is when you climb up to 6.5. But by that time, we're expecting rates to come back down. You're going to refinance and you're going to be out of that mortgage. This is not, like I mentioned last week, because I know there's some people that weren't here last week. This is not an adjustable rate mortgage. They have to qualify off of that, let's say 6.5% interest rate today. And then we would put them in that 2-1 buy down program to be at 4.5%. And the way that it works is typically it's only seller credit based, meaning that we have to get a seller credit to compensate for that 2-1 buy down. But a lot of sellers are being receptive when it comes to doing seller credit. The easiest way is when you see that there is a home that was listed at, let's say 500, that's now at 485. That means that seller, or that 480, that means that seller is willing to take $20,000 less. Well, instead of 480, we come in at 485, 490, and we get that extra $5,000 or $10,000 towards the buyer's 2-1 buy down. And it's going to save them not only on that buy down, but on closing costs, right? Because right now, a lot of people, they have to pay points when they're coming in, because when rates are shooting up consistently, right, these lenders, they have to price these out perfectly. Because if that coupon, let's say the coupon for Wall Street's at 5%, if that coupon goes from 5 to 5.5 by the time that loan funds, that lender is losing money when they sell the loan. So what's happening right now is they're charging people points. People have to pay points on the back end for closing costs in order to get an interest rate. And that 2-1 buy down cuts that out, because now the seller's the one not only paying for those points, but providing a lower interest rate for the buyer. So this is good to get them to get them in their home, build that equity. They don't have to do anything within the first 2 years. They can decide not to refinance, or they can decide to refinance after year 1, 6 months in, 7 months, it doesn't matter. But it's good for them to get in at a comfortable payment that they're okay with. That's going to help more people get off the fence a little bit for you guys. The last thing that I have, or the last question that I kind of want to open up for you guys, was the worksheet that I sent last week. I know most of you from last week were here. Was it helpful for you guys? Did you guys already fill it out? Basically, that worksheet, for people that weren't here, we talked about 2 weeks ago about what you're worth hourly, right? As a realtor, as an independent contractor, as a business owner, how much you're worth hourly. Is the stuff that you're doing worth that amount of money per month or per hour? And if not, should you be considering hiring somebody else to help you with that? So I wanted to kind of get some feedback. I know Kia was the one that wanted me to send it over. I don't know if anybody, I know I sent it to, I believe, Nikki, Kia, I think Tanya, and I think Alicia, which Alicia is not here. I don't know if anybody got it.
I didn't get it.
Were you here last week?
Yeah, absolutely.
Huh. I could have sworn I sent it. I sent it to everybody that was here. Let me make sure I have your email correct.
Okay.
I had Tanya jpstewart@gmail.com.
Yeah, I do. Let me go look again. While you ask somebody else. Hold on.
Yeah.
So
Did you?
Mike,
Yeah.
I got it, and it was really helpful. Even the like, for instance, what I realized is that I'm doing a lot of driving and showings for clients, especially clients who are out of town. And I'm probably going to start some kind of program where I kind of tailor it to let them know, like, hey, you know, we're going to look at some of your top 5, and then probably after that, tailor it down and outsource it. Utilizing new agents in the brokerage is going to be my plan, because they probably need the content and the exposure and experience. But going on showings, and especially blank showings when they're not producing anything, is really just spinning me. So, and taking up a lot of time that I could be doing something else. So that for sure is going to be what I focus on this week, is figuring out cost of showings. I know that there's a program, showing agent, and I think they charge like $100, but I need to figure out something, because, you know, like you said, a lot of buyers, they're kind of looking, but they're not really pressed about buying. And in this day and age, gas is pressed about my gas is expensive. So, you know, spending that kind of money and time is just really not necessary, especially when you can outsource it for a simple fee.
Yeah. And for those of you who don't know Kia, she has two businesses. She is a full-time realtor, and she also has a donut business where she sells donuts, and she specifically does them every single Thursday. She's at the Pembroke Lakes Mall. If you guys want to ever meet her, her business is called Los Doughs. They are delicious. They are mini. So you end up eating 20 before you realize. And yeah, I definitely recommend that you check it out. So for her, it's very important to be able to kind of subsidize or help a little bit, or get a little bit of help for one of her businesses, because she's got a lot of hats that she has to wear. But I would recommend the same thing for you guys that are in brokerages, or may know beginning realtors that need that experience, or right now in this specific market, realtors that really need their next deal, right? Let's think about it like that. Where a lot of us here we're blessed to be able to call this a full-time job, but there's a lot of lenders, there's a lot of realtors that are struggling right now, that are surviving for their next deal. You can utilize them and say, hey, look, I would prefer to have you specifically show this house for me for this client, and then if you sell it, I'll give you whatever, 200, $300, or maybe a percentage of whatever the commission is, or whatever the case is that you guys decide. There's different ways that you can really be able to help people grow in this business while still alleviating some business from alleviating some time for yourself as well. It's about being creative for the most part.
Absolutely. I'm just going to chime in really quick because I had the same sentiments. I was spending a lot of time showing when I did the calculations as well. And, it's a lot of money for gas, like she said. And so, like you mentioned, Mike, I had an agent where whenever we closed the deal, depending on how many homes she showed for me with that client, that's how I paid her. So if she showed more than 5, okay, well, boom. If you showed up to 7 or 10, then I'll give you 500 on the end. Or if you showed less than 5, then 200 to 300. And it worked out because, like you said, she was able to get the content. I got my time. Because we spend so much time on the road, and then we have to write the offers, and then we have to send the homes and do all this other stuff. So that's a way. I think it's Shawami is also another way.
Yeah, that's what Lorraine said. Show Miami or something like that.
Mm-hmm. And it depends on the price and then how soon you book the showing and et cetera, so those are different options. But one thing I was struggling with some clients, they want me. And so what I'm going to take from, it was Kia, right? That was just speaking.
Yeah.
Yes.
The top 5, doing that whole top 5, listen, show me your top 5s. Let's see which ones you really like, because a lot of times they just want to get out there and then, oh, I don't like this. And so anything after that, I'm definitely going to warm transfer over to somebody else, a newer agent or something, because it's a lot, we get burnt out doing that. So I really do agree. I have the same sentiment. So I'm going to implement that top 5 thing because it's hot out here.
Mm-hmm. Yeah, which is good. That's what you guys want to do. Put more time aside to be able to develop your business as opposed to just working in it. That's going to be the key. That's what I strive to do pretty much as possible when it comes to running the business efficiently. Right? We spoke about this. You're running a business. You are not, or there's a difference. Sorry, between running a business and being self-employed. It's two completely different things. And for those of you that really want to be able to run a business or run a team, like the big people out here, Claudia Hibbert, like Spouses Sell Houses, like these big teams as well, that they do it efficiently, and they do it because they basically revolve around their team. They built their business, and they may have a marketing person now, they may have an assistant, they may have these things, but they originally started with probably getting other realtors to be able to come in with them and kind of grow, or they could teach the realtors what they're doing, and that realtor can grow with them. And you're going to have pretty much friendship for life there if you help that realtor as well. Do we have any other questions or anything like that? I know Regine and Ellie just came in. We were just talking about the hourly worksheet that I sent last week. I don't know if you guys were here last week. But if you didn't get it, I can send it over to you. Basically, how much you make per hour according to your year to date, and what you can do to be able to get free up some of your time to be able to hire somebody to do that stuff for you. whether it's use another realtor or get yourself an assistant or something like that. For sure, you guys should be looking into, if at least if you don't start or jump into it right away, depending on where your business is at, a virtual assistant. There's a lot of good ones for real estate specifically. You can talk, with the people that are here every single week. One may have somebody that they absolutely love that they'd be able to refer you the company, but definitely look into that, free up some of your time, because right now it's about being in front of people, creating content, things like that. So Lakeisha wanted me to send it. Lakeisha, I'll send it over to you. Do you guys have any questions on the 2-1 buy down, on any programs, anything like that? Any scenarios that you had with clients this week that you kind of want to go over? Let me know. No, you guys good? Okay, so we will be back next week, same time, 10 a.m. Thank you guys for joining. Anything that you need throughout the week, just reach out to us. You guys all have my cell. You guys can reach out to me, to Yoster, to Mason. We'll take care of you guys. Thank you so much, and we'll see you next week.
Thank you, Mike. Have a good week.
You too. Thank you.
Thank you.
Thanks, Mike, for the plug as well.
No problem.
Thanks, Mike. I found it when I searched your name.
Perfect. Okay.
Working on it right now. Thanks.
Perfect. No problem. All right, Ellie, I got you. I'll email it over to you, and Lakeisha as well. Bye, everyone.
Thank you. Have a great day.
You too.